Okay, let's do part 2 now. Let's see how far we can get through chapter 14's PowerPoint here. The concept of gift splitting election is the following. Let's say you have a husband and you have a wife, and they're of course married. The husband gets, in today's terms, his 5.43 million lifetime. The wife gets that as well, 5.43. When they make gifts, the money might come from the husband's account, or the money might come from the wife's account. Whichever account it comes from, the husband and wife have the right to say that they are combining their annual exclusions together on that gift. So let's say it's the husband making a gift of $50,000. If the wife agrees and signs on to it, her $14,000, and the husband, let's go back, the husband's making a gift of $50,000 to one donee. So now, it's in 1 year. The wife can agree to let her annual exclusion for this donee apply, so her $14,000 will get subtracted from the gift as part of the annual exclusion. And the husband, of course, who is making the gift from his money, he has an annual exclusion as well. And now you've got a situation where the only amount here that's going to be subject to any kind of gift tax calculation would be $22,000, because 2 annual exclusions are being excluded from it. And then at this point, the wife can continue to agree to split gifts by letting the gift be considered $11,000 from the husband and $11,000 from the spouse, just the 22 remaining, half and half. And so, since these are above the annual exclusions, this amount goes towards the husband's lifetime amount. And let's, instead of using the number, let's just call it the lifetime amount, his lifetime exclusion. And this amount goes against the wife's lifetime exclusion. Even though it's coming from the husband's assets, the wife can agree to split so that the calculation goes against each one of their annual exclusions and each one of their lifetime exclusions, half and half. You can think through, there's some big advantages of doing that, and it basically means that between husband and wife, which again is why the same-sex marriage is a very important aspect to those people who live that lifestyle. It allows a husband or wife to effectively give away to their children, to their family, 5.43, which is the amount per person exclusion lifetime today. That's this year's amount. It's really times 2, because the husband gets 1 and the wife gets 1. So effectively, I don't know what this adds up to, but it's a lot. It's 10.86 million a married couple can give away to their children, basically, if that's where they want to go, without being subject to the gift tax. And that doesn't include the annual exclusions every year, which could be 28 per person each year per donee. And so you can see how strong the planning gets and how much more wealth can be transferred when it's husband and wife. And don't forget, it can be transferred between the two of them without any gift tax whatsoever. And here's another. This is what I just said. The gifts between spouses are not considered gifts, so you can go back and forth. And that's another big, important point for the same-sex married couples. This is a repeat charitable deduction. It's not considered a taxable gift. This is, well, you can look this over on your own, but it's really just a rehash of what we've already discussed, that the prior taxable gifts, the current taxable gifts, in any year is how we calculate the gift tax to determine if any of them are above the lifetime exclusion amount. Here's an example. Brian made a $7 million gift this year. Previously, he had made $1 million gifts. These are all lifetime or inter vivos gifts. He's doing it while he's alive. He's allowed. So he's made a total of $8 million. the actual way that the tax code taxes the amount of 8 million total lifetime gifts made thus far in this example is through this calculation, but the easier way to understand it and follow it is to look down here and just follow the general formula that we spoke about in class, which is you made a total of 8 million so far. In this year, the exclusion was 5.34. This is 2014. It's now higher. It goes up by inflation. The difference is going to be subject to the tax rate of 40%, and there's the proof that both calculations, both ways of calculating it work. To me, this is the easier way to calculate it, and so that's the way I would tell you to do it. Keep in mind that you would have to be told what the annual exclusion amount is in any given year. That's this amount, because it's changing year by year. Okay. This is not telling us anything I think that we need to concentrate on. Needless to say that the federal, I see what they're doing. First they were talking in the slides before about the gift tax, now which are lifetime gifts. Now they're talking about the estate tax. Remember, it's all combined. So to separate it out the way the slide does here is somewhat ludicrous because the gift tax and the estate tax are unified. You take both, as we spoke about in class, it's what you gave away in your lifetime and what you do at death. It's all really one. Nevertheless, the statute speaks of gift tax during lifetime, and it speaks of an estate tax at death. So I guess the slides are trying to be true to the code. This is the same basic formula that we spoke about before, only this time just concentrating on the estate tax at death. The amount owed at death. The person who gave away the $8 million in lifetime certainly will have an estate tax at death because they've already used up their lifetime credit. That's assuming they have assets when they die. If they gave away $8 million in lifetime, maybe they don't have anything left. But certain to have estate tax due, a real estate tax at death. Because they've, again, $8 million has already used up the lifetime exclusion. So again, this is a rehash of what we've already come to understand, because it's just breaking it down between slides before, which were saying the gift tax, and now it's the estate tax, so I don't think we need to go through too many of the details here. The second bullet's kind of interesting from the standpoint of just a little bit learning about how accounts work, bank accounts, brokerage accounts, investment accounts, when they're titled in joint ownership with right of survivorship. That means that two people's name is on the account. It'll be, pick on mom again, and you. And the account says that whoever is alive can get to the money. So if one person dies, the other person has the rights to all the money. And so that if mom passes away, it leaves you immediately inherit the account because the bank will immediately recognize you as being the sole owner at that point. So the gift at death of mom in this example happens immediately. So the is immediate at death. That's basically what that means. And it's just an agreement that you have with the bank. You can have that agreement with the bank. You can say, please set it up so whoever survives gets the money immediately without having to go through any red tape with the state to prove that it's your money. Okay. Notice that we spoke in class about life insurance can be excluded, but it had to be in trust. And if it's in trust, it's not owned by the decedent. So here they tell you that if you own your own life insurance and you die, the life insurance is included in the estate. So this is saying what's included in the estate. And so that's why the best thing to do with life insurance is put it in trust. It'll be outside the estate. It won't get taxed under the estate tax. Okay, I'm going to stop one more time and come back and finish this up.